We have to be aware that if you are cutting rates because the economy is weak, that's an environment where markets will likely behave as you expect. Yields will fall across the curve. But if you are cutting rates because you want to effectively finance debt at cheaper levels,
it's just his original intention that was placed out on the table.
You have to consider potentially markets behaving in ways that are not what you expect. And that's why we think of the risk being a de-anchoring of the long end of the yield curve. You effectively have 10 and 30-year bond buyers going, I don't want your paper anymore. And then you raise the question of, do you go into something like yield curve control? It's sort of a give a mouse a cookie situation where, you start doing one thing and it categorizes.
Great book if you haven't read it. In fact, it could be the last book I read.
It's probably the most insightful book of all of the books that I've mentioned in this discussion. I think that we have to be very aware that we are going into some pretty uncharted territory, and that the rule book of Fed does this, markets do that, are things that we should probably question and not take for granted.